Hey, it's Mark Eitel here. I run the Mr. Mortgage team, but I also host the Mr. Mortgage show. And I want to talk to you really quickly about it's on everybody's mind, and we're going to cover this tomorrow on the show. Um, the recession, interest rates, is housing going to crash? Is the bubble going to burst? So I've been around for a long time, started in the business in 99. So I did see that last, bubble cycle. And I wanted to share a couple thoughts with you. So I'm just in here finishing up show prep for tomorrow, and I just keep seeing this. I've got a screen up over here over and over again about how if rates hit 6%, the bubble's going to burst. And I find that super interesting. So first of all, definitely appreciation is going to slow. If money becomes so expensive at some point, it's going to slow demand. I agree with all of that. And I think one unsaid part of all this is it higher interest rates may even put sellers plans to jump into the market on hold. And what I mean by that, if somebody refinanced a year or two ago at, I don't know, say 2.5%, 3%, they may not be really excited about selling and going and buying another property at an additional elevated price, right? Because 2 more years of appreciation and at these increased interest rates, it may be super enticing to cash out that equity, but it may slow some of them down. So I don't have a crystal ball. I don't know. But what I do know is what happened in 2005, 6, 7, 8, 9, 10, because I was here. And this is one thing that's significantly, and I can't underscore that enough, significantly different about this time around. So during the early 2000s, when that bubble period started, the interest-only adjustable rate mortgage was pretty new to the general masses. That was always a commercial product, but as a residential loan product, it was introduced and people just really gravitated to it because it made purchasing a home unrealistically affordable because the mortgage payment that should have been $1,500 was $500. But my point in that is during that bubble period, over 40% of all mortgages originated to purchase properties were high LTV, high loan to value. Hell, we were even doing over 100% loans for a short period of time back then. So high LTV, adjustable rate mortgages, most of them interest only, over 40%. So that fueled a lot of people coming into the market. This time around, right now, today, less than 1% of the mortgages that are being originated to buy real estate are adjustable rate mortgages. So think about that for a minute. The vast majority, 99% of people, or greater than 99% of people, are either paying cash or have a 30-year fixed or 15-year fixed or 10-year fixed, keyword in there, fixed mortgage. And I'm going to share why that's important. So backing up to the bubble of the early 2000s, in addition to those dangerous loan products, right? Interest only adjustable rate mortgages, we had artificial demand. And by artificial demand, I mean one person was buying multiple properties, and they weren't buying multiple rental units. They weren't buying fourplexes or duplexes. They were going out here to Olympia and Black Diamond and buying 5, 6, 7 new construction, high-end single family homes in the new subdivisions. Those were purely flip speculations. Their intent was just to flip that property. So what a lot of people did was they bought multiple, as many as they could get. They used stated income, stated asset, adjustable rate, interest only loans, and they put a tenant typically in there to rent for the first year or two because most of those loans had a prepayment penalty. Again, this time around, that's not happening. We're seeing fixed rate loan products or cash, and we're seeing a closer to 1-to-1 ratio, meaning one person, one family buying their primary home. In some instances, we are seeing some second homes, but nothing like an 8 or 10 property portfolio that the average guy had. And I do mean average guy. I mean somebody with a $45,000 a year income buying, 6 flips in Olympia. That was just crazy. So what happened, where I'm going with this is, in that period of time with all those interest only adjustable rate mortgages, once those adjustments started to happen and the fixed periods expired and the interest only period expired, the payments jumped, and sometimes, I mean, double, triple payments. And all of a sudden, that person had to sell, whether they wanted to or not, they had to sell. So all of a sudden, there's not one for sale sign going up, there's 8. Because remember, this guy's a flipper. He's a master real estate investor. So you multiply that out times the number of people that were doing this, and all of a sudden there was a flood of inventory in the market. They didn't want to sell. In an ideal world, things would have kept appreciating. Tenants would have kept making the payments, and they would have had a long-term equity growth in that property. The challenge is that at the same time all of those properties hit the market, the secondary mortgage market dried up for subprime mortgages. So these easy loans were not available. And also too, even if those easy loans weren't available, I'm sure it would have been difficult, because that one guy trying to sell 8 properties would have needed one guy to come buy those 8 properties to make that an even transaction. There was a ton of supply that hit the market at the same time. So here's where I'm going with all this. A ton of adjustable rate mortgages, interest only options, all those payments adjusted. People couldn't afford the homes. They had to sell them. All of that happened, swirling around, a big tornado of crap hitting the fan. Boom, we're into a recession caused by housing. All of those properties hit the market. There was nowhere to buy and prices go down. What's different this time? No adjustable rate mortgages, cash buyers, and fixed rate mortgage buyers that are completely, fully, I mean, you wouldn't believe how underwritten people are now compared to back then. I mean, we're practically doing blood tests and cavity searches to get people approved now. So I share all that just to say, in summary, because I know I got long-winded, but I'm super passionate about this. I don't have a crystal ball. I don't know where we're going, but I do know where we're coming from. And yes, it feels the same. Appreciation has gone off the charts. What I think is going to happen is it's going to level. Yes, some areas are going to pull back. There's some areas you drive through those neighborhoods and shake your head. I can't believe this is a $400,000 house. It's not. They just got pulled along with the appreciation. Some areas will settle back down for sure, but I think appreciation is just going to flatten. Why? Because the people who own real estate right now today own it with a fixed rate loan, so their payment's not going to go up, or they paid cash. So even in a full-blown recession, they're going to let the credit cards go, the boat's going to go. They may even get a car repossessed. Hell, they might have to file bankruptcy, but they're not going to let their primary residence go. And until more demand or more supply hits the market than there is demand to take that supply off the market, prices are going to remain steady or continue to go up. It doesn't matter what the cost of money is. What matters is when there's more supply than demand, prices go down. When there's more demand than supply, prices go up. And right now, today, on Good Friday 2022, with interest rates in the 5s, there's still more demand than there is supply. And there's not an interest rate adjustment in the mortgages that are currently in place that are going to cause all these people to have to sell their houses, whether they want to or not. So until we see unemployment start to spike, I don't see where people are going to let their houses go. Yes, there is uptick in foreclosures. Absolutely, there's going to be more foreclosures as people are coming out of forbearance and they're not prepared to catch up their escrow deficits. They're not prepared. That's just going to happen. But the reality is there's still a ton more demand. And most likely that stuff is going to be purchased by institutional investors that'll just come in and recast the loan, get the people up and running again, and then sell the loan. That's a whole nother conversation. But I apologize. I went a little bit long, but I just wanted to share with you in summary, the last time we went through this, there were a lot of adjustable rate mortgages that forced people to have to sell when the payments adjusted, the interest only periods expired, they could no longer afford the house. And don't forget, they weren't underwritten on income. They weren't, the credit scores were ridiculously low, no income, no asset verification. How do you know if that person could even afford the property? This time, they're fixed rate loans, there are cash buyers, they're fully underwritten, and everybody has a ton of equity because they're putting down payments down. Even the average first time home buyer, I saw a statistic that realtor.com came out with a couple weeks ago, and I want to say the average first time home buyer is putting 9% into a deal, 7 or 9%. It was surprising to me. So ton of equity, fixed rate loans, cash buyers, until we see the unemployment rate go up, and it might happen. There might be so much inflation pressure that it starts to affect other areas of the economy, like employment, because people can't buy products, so companies start laying off. But right now, today, and in the foreseeable future, there, until you see a significant uptick in unemployment, there's no real indicator that the 6% rate that people are talking about is going to cause a bubble burst. And again, I don't think bursting bubble is the right term. I think we see slowing appreciation. We see price easing in some areas, but I don't think your $700,000 house in your brand new, newly constructed neighborhood is suddenly going to be worth 500,000 over the summer. That's a bursting bubble. I don't think we see that happening. I think we go into a single digit appreciation cycle. I think we see rates go up a little bit from here. I see us going into a recession, and somewhere, I don't know, 16, 18 months out, the Fed steps in and loosens monetary policy again and tries to pull rates back down. But we're not going back to the 2s and 3s. So those days are over. I mean, just like, you know, your rock star high school and college days, awesome memories, but you're not getting your hair back. So anyway, hope I hope all that helps. If anybody has any questions, feel free to give me a shout. All my contact information is always somewhere on this page. But yeah, exhale. Tune into the show tomorrow because we are going to cover some of this. So thank you for letting me rant. If any of this is of interest to you and you want to talk more, just touch base with me. Thanks. Happy Good Friday. Have an amazing Easter weekend. And yeah, let's hit it hard next week. If you need us, we're here. Thanks.